telling me that you have a way to defer the tax situation there? Is that what you're telling me?
Yes, absolutely. Yes. And so the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye-opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The Deferred Sales Trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
Hello, everybody. Welcome to another Capital Gains Tax Solutions Mastermind Masterclass, where we believe most high net worth individuals and those who help them they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust. It could also be a 1031 exchange sometimes. Sometimes it's a Delaware. Sometimes it's donor advised funds. Can help you create and preserve more wealth, defer millions of dollars of capital gains tax, hopefully maybe help you grow your business if you're a business professional. But ultimately, hopefully you can start to see how you can unlock freedoms for yourself and for your clients. And so in today's kind of a theme for the day, we're talking about the concept of weaving your wealth mission into a capital gains tax solutions exit plan. And so step number one is, do you have a wealth mission? What is your wealth mission? I think we all have, hopefully we do have, mission statements for our family, for our businesses, for what we're doing. But do you have a wealth mission statement or something that clearly defines where you're trying to go, what kind of legacy you're trying to leave, and how do you enjoy your life and your time and your energy along the way and give to the causes you believe in? What is that mission for your wealth? And what does it mean to have a plan or a wealth plan that is on a mission, right? That it's going to make a difference for you and your family. I know for some of our clients, it's, hey, I want to be able to spend more time with my family. I don't want to have to spend as much time working on my business. Or it could be, hey, I want to diversify my wealth away from, active apartment complex investing to more of a passive investor. Or maybe I want to increase my cash flow, exiting out of stocks or businesses or cryptocurrency where you feel like you're, perhaps asset rich, but cash flow poor. It could be a number of different things. It could be 1031 exchange, just not wanting to deal with sellers who aren't willing to cooperate with you when interest rates jump really high and they still feel their values are pretty solid. Because guess what? Rents are still holding on pretty tight. It could be a number of different things. And our goal is to help you clarify some options, get some clarity on what's available for you, and then hopefully encourage you to inspire you to take action and use a vehicle that's going to work for you. So I am joined by some amazing strategic alliances of mine who do a great job. One of them is Pierce York. He's out of Newport Beach. He is a commercial and luxury realtor there. He's also a part of the EXP family team that I'm a part of as well, EXP Mastery. Pierce York, how are we doing today, brother man?
Awesome. I'm doing super well. How are you?
I'm doing well. See if we have the Jake Miller. I'm not sure if he's with us quite yet. He might be a little bit late. Okay. He might be back. So Jake Miller is a financial advisor, one of the top in the country, we believe, entrepreneurial, amazing. Hopefully he'll come on a little later. We also have DJ Carpenter. He's another one of our Strategic Alliance financial advisors out of Washington. Also fantastic because he loves real estate as much as he loves the stock market, which is rare to find. And a lot of advisors to have a good balance approach there. We also have welcoming, who else do we have in the house today? Rebecca Munson out of Lake Tahoe, Truckee, amazing realtor up there. So welcome, Rebecca. So I'm going to pass it to Pierce here. So Pierce, I gave a little bit about the vision today, about what we're going to be covering. By the way, we're also going to cover a few other things. So Pierce, why don't you take it away about what else we're going to cover today?
You did the vision already. We're going to do some Q&A. We're going to give you guys the opportunity to ask your questions. We're going to do a deal close story of the week. We're going to run through some potential scenarios. There's a live deal. We're going to let it flow, and we're going to see where it takes us.
Exactly. And this is the whole point, to mastermind, to masterclass, and to answer objections and questions. And sometimes it's live deals, sometimes it's deals that are just closed, and sometimes it's just the common theme question that we continue to get. But I do want to open up to Jake Carpenter here. So Jake, in the beginning, I talked about weaving your wealth mission into a capital gains tax solutions exit plan. So I'm curious, what do you think that means?
Well, most of the time, these clients that we work with are fairly high net worth. Some of them are ultra high net worth. And it isn't a one strategy kind of addresses everything type of approach. So what I have found is that the Deferred Sales Trust has been a really good kind of a center to the wheel of addressing things like federal estate tax issues, state estate tax issues. It's addressing tax flow issues. So we've got a lot of folks that are very asset rich, cash flow poor. And if they convert from asset rich to cash flow rich, they're generally going to have to address or pay a significant amount of taxes, which is going to destroy their cash flow. And if you can address those issues through maximizing what they can put in their pocket, and in essence, redirecting that tax bill from the IRS back into their pocket through the use of the Deferred Sales Trust, and weave it into the other strategies that they have to use anyway, which is, for an example, if they have a $20 million transaction, but they have a federal estate tax issue, and you can not only put the capital gains tax back in their pocket, but you can also remove that $20 million from their taxable estate on a federal and state level. We call it a death tax. That's what I would call weaving the strategies together in an overall wealth plan, so that we're in essence, we're killing two birds with one stone. And this is the Deferred Sales Trust, for whatever reason, is not widely known, even though it's based on almost 100-year-old tax code and 25 to 30 years and thousands of closes and quite a few dozen IRS audits. So this is not a new strategy, but that's what weaving it into their wealth plan means to me, and how we use it in our practice.
That's amazing, Jake. I love the way you put that. I love the way you're looking at the tax flow perspective. You're looking at the capital gains tax perspective, and you're also looking for different families have different needs at different times perspective, right? And that's really the key, right? We want to encourage anyone who's listening, whether it's yourself or one of your clients, is really step one, having that vision and that clarity on what you want your wealth to do, right? If you have a budget, you're telling money where to go before the month starts, right? Well, if you have massive amount of wealth, you got to tell basically where your money to go over the next X amount of generations and X amount of years that you have, and as well as what does it look like for you in the 1, 3, 5, 10-year term. And some things might come to the top of the level of, well, I want to diversify, right? I don't want to necessarily have all my holdings in one highly appreciated asset, or I fully depreciated out of an asset, so my tax flow has gone lower now. And even though if I move it over, I'm not going to have as much depreciation to offset that cash flow. And so these are the different things you want to do, but realize that we're all in, I think, this struggle together, because guess what? The government has a spending problem we haven't caught on yet, which means we have a tax problem, right? So taxes aren't likely to go down anytime soon. And in fact, I'm originally from Taxifornia, and it's brutal, right? To see what's happened, places like New York, New Jersey, of how restrictive and how punitive some of these taxes can be. But if you have a team, there is hope. And if you have a way to get some freedom, I think it creates opportunity for people to get unstuck from where they're at. And so see some of the questions you might ask yourself. Do you know, or those in your family know, or if you're helping your clients, do they know that what they're trying to do actually matters, right? What it matters for their future? Do they feel like they are all rowing in the same direction? Like when it comes to wealth plan and how that's going to look with, retirement or selling or exiting assets. Do you feel like your real estate or business rich and cash flow poor? Are you concerned about how your wealth is not diversified? Are you frustrated with the 1031 exchange pressuring you to overpay for a property in a short period of time? Perhaps you want a new entrepreneurial dream. Perhaps you're like, hey, I'm not ready to be passive yet. I just want to redirect my active general partner or tech startup, whatever that entrepreneurial drive is, but you need to unlock the capital for something else that's been locked up and it's subject to big capital gains tax. In fact, Jake Miller and I are looking at a large deal. Jake, if you're there, you could bring in, and it has to do with a stock sale, and it's a large stock sale that's had any depreciation because it's stock, and they're looking to capitalize potentially now. Whereas before, because of the tax, they weren't able to do it. So Jake Miller, how you doing? Welcome you to the mastermind.
Absolutely, Brad. I don't know if you can hear me okay.
You sound good.
Awesome. Amazing. Hey, I'm here in the Mexico City airport after taking care of some legal paperwork for some of our clients' investments. But to your point, this client of ours, he has around 30 million in Apple stock, one of the senior managers there at Apple that's retiring and is looking to diversify his assets and his investments. He has around 45 million altogether in stock. And so we're looking to help him in a number of different ways with the Deferred Sales Trust so that he doesn't have to lose a very large part of his net worth to taxes because of him needing to diversify now that he's getting ready to retire.
And it's a beautiful thing, right? He can diversify, but also not only can he take that Apple stock, which I'm not even sure that Apple stock produces a dividend, does it or not, or no? Anybody know that? Maybe not.
No.
Okay, so think about that. It's not cash flowing. It's 30 million. Of course, it's had an amazing run, and it might still have a great run. But what if you were to take 10 or 15 million of that, move it into either a deferred sales trust, or even if you wanted to go charitable, he could. But let's say a deferred sales trust that's producing 6, 7, 8%. That's cash flow. Now you say, well, where can we invest that? Well, it can be in stocks, bonds, mutual funds. It can be in real estate. It can be in different asset types that produce that cash flow. But that's the point. You're taking something that's highly appreciated, that's subject to huge tax, and now we're moving into a cash flow producing machine, but in a very tax efficient way. To Jake Carpenter's point in the beginning, you don't have to take all of it all at once. So in this scenario, let's imagine you did exit 30 million. We would use the DST plus on that, by the way, for any public stock, regardless of the size. But in this scenario, that 30 million is outside of the taxable estate, number one. So we've just eliminated 40% death tax on that entire amount, minus what any exclusion would be around, given what year he is the amount that he would die and his wife would die, right? If he's married. But any of the growth now too. So that 30 million, let's imagine he puts it into some real estate, another business venture, a tech startup or something else. or just stocks, bonds, and mutual funds. And that 30 million inside of the DST plus grows to 100 million. Jake, I'm not sure how old he is. Is he 50, 60? How old is he? What'd you say he's 50? Because Jake looks like he's in Mexico City.
Sorry about that. He's actually his early 60s, 61-ish.
Okay. So, right. So let's just say he goes to 100. This 30, let's just say, goes to 100 million, right? Okay. Over the next 40 years. All of that's outside his taxable estate. We eliminated that problem in one day without charity, without having to give it all away or buy a bunch of life insurance or have like 50 kids and try to gift it away. We've just outside the taxable estate. So that right there can be generational wealth for many generations to come. And that's why it's so important to focus on what your mission is, right? So that you can, look for creative solutions to help you solve what you're trying to do. And you want to weave in those strategies to help you solve your challenges. And so, but number two, you can invest it into real estate. That guess what? That real estate can have a depreciation schedule. So now you're taking something that's illiquid or that was liquid. You are putting to something that's illiquid. So that is a downside if you put some of that into real estate. But that real estate, if the way we structure it, if you are a general partner and you're buying that asset, you can get depreciation on that asset. So let's say, for example, he bought a $10 million apartment complex. And 20 million is in other stocks, bonds, and mutual funds. That 10 million in that apartment complex, he can get up to about 80% of the depreciation schedule. Let's say he bought it all cash, right? He can get 80% of the depreciation. He could also put $3 million down, buy it for 10, right? And still get 80% of the $10 million depreciation schedule, the way we structure it. So now he's increased his tax flow on the depreciation side, which is good. You want high tax flow because then you have cash flow to offset it. I guess a better way to put it, but you want high tax depreciation buildup, right? Depreciation that's building or getting bigger, ideally, because you're buying more assets to offset the cash flow that's in any given year, and that's the ideal way to take cash flow. So that is a concept there. Pierce York, you want to pull any nuggets out of that or questions out of that?
Yeah. So I was doing a podcast this morning for capital gains tax
cost segregation, yeah.
Cost seg. Mm-hmm. And we were just kind of discussing some of the some of the mechanics of it and so on and so forth. You guys can check out that episode on YouTube, rate, review, subscribe, right? Hit the like button. But one of the things that we were discussing is with the 1031 exchange, your depreciation schedule travels with you. Mm-hmm. And we were kind of going down this little rabbit hole. And to be honest and fair, I was kind of leading them down the rabbit hole. It's the idea that when you do a 1031, which could be really good, right? Your depreciation schedule is going to travel with you. Mm-hmm. And so after, you have to continually upgrade, right? But you're also still chipping away at your depreciation ability, to depreciate the full asset. And I was saying, with the Deferred Sales Trust, what's really nice is not only are you don't have the time constraints that you have to just force yourself into a deal, but when you do go back into a deal, you have a brand new full depreciation schedule. You don't have to have that chip away. So it's not only just the cash flow piece of it, right? It's the tax flow piece of it. And it's just the ability to have so many more options with the Deferred Sales Trust. It's just another, cherry on top of the sundae of cherries at this point.
It's another ROI, right? Because one of the biggest objections we get is, hey, it's so expensive, like these ongoing fees, right? And why are we paying these fees, these ongoing fees? Well, because it's a business trust, it takes management. But the question is, rather than asking that question, is it too expensive? The question is, how do we make the Deferred Sales Trust an investment and not an expense? And one of the best ways to do that is by investing into assets that give you a brand new depreciation schedule and boost up your depreciation tax flow, if you will, to be able to offset your cash flow in a given year, right? And that's a powerful way to all of a sudden increase your ROI. Now, if you don't put it into assets that are hard assets that have that are depreciable, then that's not a part of your ROI. And some clients choose not to do that. They're just like, hey, put me in the biggest companies in the world, S&P 500, and just let me just be passive, and that's fine. But if you could be a little more entrepreneurial, you can have the ability to access this depreciation. So Pierce, any thoughts on that?
Yeah, the other thing, to that is, we have funds and stuff that, you could go in as an LP and be in a similar situation as, just the biggest companies in the world in the S&P 500 and take your return and still capture some of the depreciation. So, there's
just on stock. Yeah. It's just, if it's stock market related, it wouldn't be, because stocks are not depreciable. Right. But there could be some creative ways to go as an LP as well. Yeah, there could be some creative ways. So, but yeah, it's that's one of them. The other one would be hopefully optimal timing, right? So hopefully, you didn't buy that apartment complex at 12 million, you bought it at 10 because you waited, right? So if you were doing that 1031, and you said, hey, I'm going to do deferred sales trust, well, hopefully that gave you some time and some ability to strategize the discounted price when it made sense for you, rather than having to buy it within that 180 days. And that hopefully gives you the deferred sales trust. It's an investment, not an expense, because it gave me the one thing that nothing can give me back on these 1031s, which is time. And so that would be number 2, right? What would be number 3, Jake? Anything come to mind? We can do Jake Carpenter too. Jake, what would be number 3 way to make the deferred sales trust an investment, not an expense?
Well, that's exactly the point that we want to use it for, is create an asset, not a liability, right? Mm-hmm. So we want to find good opportunities. Like you said, 1031, you're selling high, you're going to buy high. No, the depreciation schedule carries over. So we're looking for time to find the right opportunities. We're looking for the ability to reset the depreciation schedule. We're looking for cash flow. Like this Apple stock, there's no cash flow to it. Just like everyone right now, when the economy gets bad, they want to go out and buy gold. And I'm like, wait a minute, gold doesn't pay a dividend. Okay. So we need income. We need tax advantages. And that's where a lot of the real estate can help, is it can create some depreciation to offset the cash flow that comes off of these things. And we should be seeking out returns that more than make up for the cost and expenses of the business trust, because we're basically trying to make a money machine here. And it's like any business. There's some very, very profitable businesses that put a lot of money in your pocket. But is there no expenses? Well, of course there's expenses. So there's going to be expenses, but your expenses are going to pay a team of people that are here to make sure this is an asset for you. And it fits your risk tolerance, and it fits the kind of assets that you want and the kind of diversification that you need. So we are here to make sure that we build a team around you to create, to use this trust to create an asset for you, not a liability.
So I love that, Jake. And tell me what you think about this. It sounds like, especially DST 1.0, we are going to delay a liability to create an asset. We're going to delay a liability to create an asset. So what is the liability?
We are converting a liability to an asset.
Well, so it's delayed, right? So, and that's the key, because it's deferred, right? So, and then we'll go to DST 2.0 in a second here. But DST 1.0, the tax is typically 25 to 50% of your gain, no matter what state you live in, no matter what you're selling. It matters what you're selling if you depreciate it, right? So, but it's set to potentially go even higher, another 6 to 8% higher at the end of the year here. We'll see what happens in the new year after 2023. But think about that. 25 to 50% of your gain is the tax liability that you can delay. So you can delay the liability, and then you can turn around, and the trust can invest into assets, and it can invest with you into other assets, and it creates even more wealth. And this is how the DST becomes a wealth machine. It's not just I'm going to put it here as an IRA, or put it here as a 401k, or sometimes people think, well, in a 1031 exchange, at least I got the ownership. I can continue to get upside, right? Whereas in this scenario with the deferred sales trust, yes, at first you're just a lender, right? You just lent the funds to the trust in exchange for a promissory note. And yes, you delay the tax liability. You're living off more interest, hopefully, as you delay and as the investments perform. But then you can partner with the trust, buy more real estate, buy another business, start another business, and that creates an asset. So it's a great way to build wealth. So delay a liability to create an asset. Now, here's the next part of the tree: to create depreciation. So think of it, you went from the Apple stock scenario. Okay, you definitely had an asset. Okay, you definitely had a liability, but you had zero depreciation, zero cash flow. Okay, and now we're going to exit that 30 million. We're going to delay the liability. And in fact, let me do one more on that. If we do DST 2.0, we're going to eliminate the estate tax, right? But we'll wait for that one in a minute. But we're going to delay the liability. We're going to create an asset by partnering with the trust, which is going to create depreciation, which is also going to create cash flow, right? And so that all of those things open up freedoms for you, right? Freedoms for you, time, energy, retirement, diversification. Other parts of that too are for those who are in too much debt right now. And they're selling these 1031 properties and they get this massive amount of debt that they have to replace on the next deal. And A, they may or may not qualify for the debt. B, you may not want to buy the deal anyways because prices really haven't gone down that much in commercial real estate. But C, now is the time to be safe and out of debt and diversified in some of the biggest companies in the world while you wait, liquid investments, while you wait for investment opportunities to drop, right? So
Mark, the other thing about debt right now is people are coming out of a debt situation at 2, 3, 4% into a 6, 7, 8% interest rate environment. That is really tough.
Really dangerous, right? And it's dangerous and it's volatile and it's moving. So to us, if you can get liquid, diversified, and if you can be in the ability to dollar cost average. By the way, you can go into real estate lending, you can go into hard assets too, and you can get a mix. But the point is to be patient, to be out of debt, and to be ready to pounce. Pierce,
can I add one more freedom to your
Sure.
list there if you're taking notes? One that's really important with a guy I was just talking to is partnership freedom. Sometimes people are partnered up with someone else and they don't always want to move in the same direction. One can go one direction into the deferred sales trust and the other one can continue on.
That is a great point. And sometimes too, the reason someone wants to sell or won't sell or the hesitation is because they don't want to pay the tax. I mean, I would honestly say it's the number one or number two reason why anyone won't sell is because of the capital gains tax. It's on their mind. So when you have this friction, the partner can bring in and say, hey, I know you had this friction about selling and not selling and you not wanting to 1031 and me wanting to 1031, but guess what? I found a creative solution. We can each still go our separate ways. The whole entity doesn't have to move. You can have a deferred sales trust. I can have deferred sales trust. You can put all or a portion amount in there. You don't have to do it at all. You can just pay your tax. But the point is we can now sell the asset, go our separate ways, and still defer our tax. That goes a long way to helping people to be more amenable to selling in case one partner has a friction. We've seen it all the time. We just did a $13 million deal in San Diego. 4 partners. One of them just wanted to pay the tax. He's just ready to be out. He paid it. The other 3 all deferred their tax using the deferred sales trust. It was like a 21-day sale from the time they saw us on YouTube to the time they closed. And they're all really happy. It's going great. And they sold at a really good time. I think it was like February of last year. So about a year ago before things started to really go sideways. So now I'm going to go to DST 2.0. I'm going to bring Pierce back in. So 2.0, Pierce, what do you think about this? Because we're eliminating the estate tax, it's not just deferring estate tax, it's eliminating it. So we're taking an asset like a $30 million worth of stock, right? With a person who's 60 years old, where the valuation could easily be 100 million within 40 years. We eliminate the liability, Pierce.
Okay.
To create cash flow, because he has no cash flow. Okay. To create an asset, right? More assets, which creates like if they buy real estate assets, right? Or to, I guess a better way to put it is to purchase new assets, to create depreciation. Now, they do pay some cap gains tax as they get payments out, partial interest, partial cap gains tax during their lifetime. It's a little bit of the downside for the DST 2.0, but to me, that's a really powerful way to build the wealth. What do you think, Pierce?
Yeah, I like it. So you have eliminate a liability, to purchase assets, to cash flow, to depreciate.
Here we go. Yeah, eliminate the estate tax liability, defer the capital gains tax liability, right? Or delay would be another back to that one. To create cash flow immediately, stocks, bonds, mutual funds, or dividend paying stocks, right? To also purchase a new real estate asset, which creates new depreciation schedule, right? So I think that's a good way to look at this too, just to keep it really simple. Like, what are you getting on one side versus the other? And how many of these can stack up to really help you grow your wealth machine?
We need a circle diagram deal, like you see in biology. It's like the cycle, right? Like eliminate
Circle of
your
life.
estate tax, defer your capital gains tax, purchase assets, depreciate, cash flow, defer your assets, eliminate tax, and it's the wealth building cycle.
I think that's good. Rebecca, I'm gonna bring a female touch and maybe Micah in too, because these guys have been talking a lot. So Rebecca and Micah, you ready to go, ladies? All right. If there's anything we're saying that's just like, I don't get that, or that didn't sound as clear as it could have been, maybe you gals can help us. Rebecca, I'll start with you.
I've heard it multiple times. It actually sounds pretty clear to me. You keep talking about delaying the liability though. Can you explain that maybe a little bit more?
Yes, I'm gonna have Micah try to answer that. Micah, what do you think delaying the tax liability means, really?
I mean, really, it's just kind of kicking it down the road. I mean, you can't get away from paying Uncle Sam, but it doesn't always make sense to do it right up front, right when you close the deal. We actually had a person call us this last week who was wanting to, now that it's tax season, say, hey, what can I do? I just sold this property and I'm going to have these capital gains. Well, the cold hard truth to that situation is we can't do anything at that point because it's too far past. So it's really important that we get the word out, that people know there are options available, because there's too many people that don't realize the implications of selling a property, selling an investment, and until it's time to pay Uncle Sam.
Yeah, well said. And so, yeah, so to sum it up, we're deferring or delaying the tax, kind of like an IRA or a 401k or a 1031. And really what the government says is, hey, you still owe it. You still owe us that tax. However, we'll charge you zero interest as long as you use these tax vehicles, and as long as the actual funds are in business ventures or business purpose investments, which actually creates more jobs and more tax revenue and all of that stuff. They actually win the most here. So it's a way for them to incentivize the investment and business commerce, on a big scale. So really what we're saying is, if I said, hey, Rebecca, $10 million apartment sale in Truckee, I have zero basis. It's still California, although you just wish you're on that other side, but you're not quite there. And California just is like, yes, we got you. It's like 40% versus the Nevada side, which would be about 25-ish with federal. So it's huge, right? So you say, the government says, Rebecca, tell you what, you invested into this trust. You still owe us that $4 million, but we'll charge you zero interest loan. And as long as you don't touch that 10 million, you just live off the interest. You don't pay we don't charge you interest on that 4 million, and you don't pay any tax on that 4 million. When would you want to give that loan back? When would you want to pay that back?
Never.
Never. Okay. Now the interest payments, don't get me wrong, you're paying tax on that. You're not getting out of that. That's ordinary income tax. You're paying that on that. Okay. So you get a 1099 INT if you're wondering. But that's what we're saying. And so these are 10-year increments, and every 10 years you can renew. And most of our clients structure these promissory notes where they're just going to be living off the interest and not dipping into the principal. Now, let's say they do actually want to dip into the principal. They're like, look, I sold this. I want to go buy this fancy house in Incline Village for a couple $1 million. Okay, great. Then let's do a distribution of $2 million, pay your tax on that, and go buy that fancy house in Incline Village. Still do that. If it's personal, taxable. If it's in business, right, and you don't touch the principal, it's delayed, right, at 0 interest, which is great, even though you might be making 6, 7, 8%. Cool, right? That's the point of all of this. So does that answer the question, Rebecca? Did that clear it up a little bit better?
It did, yeah. And so if you need some of that principal, then you do get taxed on it. But otherwise, if you're just pulling, you just get taxed on the distributions from the interest. You
got it. And then you could pass it to your kids too, right? So this 10 million, let's imagine mom and dad lived off of $800,000 on average per year the next 40, 50 years of their life. And then they pass it to kids. And let's say they had 4 kids. They might say, hey, via the living trust, I want our kids just to live off the interest as well. If the kids say, hey, I'm ready to take it and pay it, and the living trust says that's okay, well, then they would pay the capital gains tax there. So the downsides of the deferred sales trust, you don't get a stepped up basis, right? On the DST 1.0, there's no stepped up basis. There's no stepped up basis on the DST 2.0 either, but it's eliminated the estate tax, and we have, you've been paying capital gains tax over the lifetime. So a little bit different there. But the point is, how do you create more wealth? So now I'm going to pass it to Micah. Micah, anything else about that or anything else that we said that kind of stuck out for you, or any questions or comments?
I really just like the freedom that it gives you. I mean, there's just so many more options that are available to you in deploying the DST, in helping to eliminate the
estate tax.
Eliminate the estate tax, defer your sales tax. There's just, it's really pretty neat. Now, I mean, it's not like you're going to be getting this for free. There are fees involved. That's why there's a certain threshold when it makes sense.
And what is that threshold, Micah? Do you remember?
It's $1 million. Mm-hmm. Yeah. I mean, if you have other deals and they're less, it just makes better sense for you to go ahead and pay that tax at the time of the sell than to deploy the DST.
Yep. That's what we found. Yeah. $1 million net proceeds, $1 million gain is the minimum. Now, if you had 2 at 500 each that you can combine into one, that's like, we'll make a little exception, but that's the minimum. Now, if you had a primary home, we'd probably like to see a 2 million and 2 million, to be honest, is kind of even healthier, because the 121 exclusion gives you an extra 500 or 250 if you're single. If you live there 2 of the last 5 years, you could say 1.5, that's not bad. But if you want to keep it real simple to say, do you have a $2 million gain on your primary home? And do you have at least, let's say $1.5 million, $2 million in net proceeds? Hey, let's talk, right? To keep it real simple for those that are selling luxury real estate for primary homeowners. But everything else, it's like $1 million and $1 million. Pierce, you want to add anything to what was just said?
As far as the minimums, I did have a question for you. I mean, if someone already has like a DST, let's say they put a $5 million asset in and they got multiple assets, and they have some that are, now they're $400,000 single family homes or whatever. Could they use one just because their trust's already set up? And
yeah, they could have some scale. Like, let's say they imagine they already had $1 million in there and they wanted to add a little bit to it. They could. I mean, I have a deal right now in Oakland. We're doing that. And she sold a place in Oakland, and then she used a portion of it to buy a fix and flip in San Francisco. And now she's selling that now. And it's the exact scenario we're going through. The only reason we're doing it for this second one is because she already has the first one established, and she's in California. So it's extra painful, right? So the answer is yes. And by the way, we did promise we would share some deal stories. Here is one right there. This is San Francisco duplex, and they lived in one half and rented the other half. I'm not sure if it was high or low, but many, many years. So they did partial 121 exclusion for some of it, but then the rest of it to the Deferred Sales Trust. That was awesome. That was like 1.25. Here's one up in Placerville. I actually was the broker on this deal. I sold it, $2.5 million sale. In fact, Warren Strand was on about 2 weeks ago, and he shared his entire story. This is his complex right here. And it had 7 units in the front, and then it had like a fourplex and like a duplex over here. And it was cool property. Like it's over like I think 1.5 acres. It was big property, like on a hill, like beautiful property. But just he was driving 4.5 hours. Like, so his freedom was with his daughters, right? He was trading all the T's, toilets, trash, and liability for his twin daughters' time and energy, right? He's like, forget this. I'm going to sell that thing, defer the tax, increase my cash flow, by the way, by about 60%, and then spend more time with the family. And he is like so relaxed now. You saw him there. He's just like, he got back from, I think another deal he was working on that he might want to sell too. But the point is, he's just so happy he did it. Here's another one we did in, this one was in Menlo Park. It's sold for 1.45 million, like a little tiny house for a client. That one was a good one. Here's the one in Oakland I was just telling you about. Here's the Oakland one. She sold this in Oakland. She does an amazing job of like fix and flips. I got to get her on the podcast. Actually, she's actually been on here undercover, just so you know, before. Here's another one we did in Cupertino, 2.35 million here. Okay. Let's see here. Here's one we did in Monterey, 1.4 million. We're working on another one for a client on that one. Here's Sarasota. That one was a $3 million sale. Okay. So these are actually a lot of single families for these ones here. Here's one with Ron Anderson. It's like a $4.5 million apartment complex out of Colorado. So you can hear his story on YouTube. He shares this story. So that's just a few. If you want to look for some bigger ones too, here's a $20 million deal out for a syndicator out of Nevada. This is one of 5 deals that they've done. So you can hear David share his story. That being said, I'm going to open it up for anyone who has questions. We've been talking a lot, the core team here. Does any of our new, especially anyone, we got Clayton. Hello, Clayton. Hello, G. Miller. Hello, Jay Fran. Marty, nice to see you on here, sir. We got Wayne. Does anyone want to say hello, ask any questions, comments? Love to hear from everyone who's attending today.
I think Wayne had a question about op zones.
Okay, let's look for it. Are you familiar with Bell Point Opportunity Zone Fund, Oz? I'm considering using it to postpone some of my failed 1030 cap gain. Interesting. So I haven't heard of the particular Bell Point Op Zone Fund stock. It would be intriguing to see what their performance and track record has been so far. And we love opportunity zones. A, if you can trust the sponsor, and B, you can hold on for basically 10 years, right? I mean, that's great. Like if you don't need or want any potentially of the principal and you just want some cash flow, then that thing is awesome, right? Because you get a lot of tax-free money from what you put in. You defer it for a little bit. You still have to pay it within a couple of years, right? But then anything beyond that is going to be tax-free, which is a great way to do it. Challenge is, generally speaking, deals are hard to find, and they're overpriced already. So it's kind of chicken and the egg. I just haven't seen too many people do it, but I would like to see that fund. That sounds pretty intriguing if it has some good opportunities there. We have, where can I find info on the DST 1.0 versus 2.0? Good question, G Miller. G Miller, it kind of sounds kind of cool, but I guess Mr. Miller or Mrs. Miller, I'm not even quite sure, but you can go to my YouTube channel and you can search Deferred Sales Trust Plus or DST Plus or DST 2.0. I think I've got like 2 or 3, maybe 4 videos where I break down the differences between 1 and 2. So that's where I would go, and you can check out our playlist there. It's the Capital Gains Tax Solutions YouTube channel, Capital Gains Tax Solutions YouTube channel. All right, what else do we got here? G is Gordon. Yes, thank you, sir. Let's see. Okay, Clayton says, is there an annual fee based on the funds you start with, or does it increase, decrease with the value of the trust? Great question, Clayton. Yeah, it increases and decreases with the value of the trust. So let's talk about fees. A, there's one-time fee to the tax attorney at the close of escrow based upon the gross sales price. B, that's about 1.5% on the first million, 1.255 on anything above. B, there's the ongoing fees. It's basically the financial advisor like Jake Carpenter or I, or me, Jake Miller, where we would collectively, it's generally it's about 1.5% to 2%, depending on how and where the funds are invested. So it's about that range. So like if it was $1 million, it'd be at 1.5% to 2% that actually hit the account. So let's say you sold an asset for $3 million and you had $2 million of debt and $1 million hits the trust, and we're going to charge on the net into the trust. Okay. So in that scenario, it would be about $15,000 to $20,000 on a recurring basis. Now, our goal is to try to net typically around 8% net of those recurring fees. So, yeah, hope that answers your question there. What else do we have here? Is a stock you can get into and out of easily? Is it a stock? Oh, can you, like, I think what you're saying is, can I invest into a stock and get in and out easily? Answer is yes. I'm using it to bump part of my cap gains into 2023 and stay 50%. Oh, yeah. So this is a good point, Wayne. So one of the unique things to make the deferred sales trust an investment and not an expense is by taking principal at optimal time. So for example, let's imagine your income you knew was going to be very low in a couple of years, and you're selling a highly appreciated asset in that year, same year, right? But if you take all of that cap gains and all that income, your income goes to the roof. Instead, use the deferred sales trust, and you might only take, let's say, $50,000 of principal. Well, I believe, Jake Carpenter, correct me if I'm wrong, I think up to $43,000, you're at 0% cap gains tax rate. I think that's what it is right now. So
yeah, there's up to a certain threshold, there's zero.
Yeah, and yeah, exactly. So there's if you go to the federal IRS capital gains tax like rate table, it says like married or single, and depending on where you're at, actually, it might be a little higher. So don't quote me on those numbers, but just know that if you're making low income, and if you have a deferred sales trust with millions in it, and if you take principal in that same year, the neat part about it is if you have a low income, it could be it could be at 0, or it could be at the 15, it could be at the lower rate. Where you get in trouble is when you take it all in 1 year or big chunks, and it breaks you through the ceiling, and now you're at, depending on what state you're in, 25, 35, 45%, depending if you have depreciation recapture. Okay, so there's a lot of moving parts there, Gordon. I can't answer it without having all your specific facts here, but the concept is true. What you're thinking, well, if I have low income, can I take principal in a given year and therefore pay very low cap gains tax? Yes. Okay. Here's the
rate if you're single is 41,675. There's 0 capital gains. If you're married filing jointly, it's under 83,350. There's 0.
Okay, there it is. Yeah. So basically, it sounds like if you're about 80,000 married, if you take, I guess, imagine you had no income for a year, but you took $79,000 of principal. I think what you're saying, Jake, is you'd pay 0 cap gains tax on that 79. Is that right?
Correct.
Yeah. So yeah. Now, here's the downside a little bit of the deferred sales trust, that when you take payments from the trust, it has to be interest out first. So let's say you closed a deal for $3 million 2 years ago, and you were delaying the interest for a couple of years. And then year 4, you're like, oh, I have a low income year. I want to take 79,000 out of principal. Well, in order to get to that 79,000, you've got to burn through the interest that's been accruing. That makes sense? So it's not perfect, right? But are there years that you could line it up where you've been taking interest only payments, and then your income dropped on some other level, and then you dipped into the principal? Yeah. So we call that tax flow engineering. So, Mr. Gordon, hopefully that answers your question.
So to clarify, the income thresholds on married filing jointly is if you're under $250,000, then you can take up to 89,250 of capital gains rate at a 0 tax rate.
That sounds correct. Yeah. And by the way, too, just as a reminder, we do need to keep 20% liquid at all times, right? Part of that is to make sure that we can A, make the payments to you, B, have liquidity to make the payments to the trustee and the tax returns. But C, also not to stretch this business trust too soon. It doesn't mean liquid, by the way, doesn't mean you got to just stick it in the bank earning 0. It actually typically means investment grade securities. So that was a good point you brought up there, Michael, on the chat. Thank you for that. What else? What other questions does anyone have, or comments or thoughts? We have a few more minutes to help anyone, everyone. We have Clayton, we have Gordon, we have Jay Fran, we have Marty, we have Wayne. Anyone else? You can unmute yourself, say hello. You can. Looks like we have something in the chat here. Micah, you want to read that, and then I can not to flip back and forth all the time.
Yeah. So Clayton's just asking if, speaking on the bank earning zero, does the trust count in an interest-bearing account? But it does. It is in an interest-bearing account typically.
T-bills and money markets are 4.5% right now. So
Yeah, we can get it out right away with that, and that's the beauty of keeping it in liquid investments or trade plus 3, just a couple days, and then you can go buy your investment real estate deal. And that was one of the best deals that happened in 2006. The gentleman sold, put everything, all the money morning quarterback. 5 years later, he bought the property back at 60 cents on the dollar. He had it in liquid investments that were hedged and protected while he waited for real estate to drop. I mean, he played it perfect. It was amazing. It's like, probably never happened again the way it happened, but it is possible to do that. And if it's even possible, then why don't give it a shot, right? If you know you can sell high right now, achieve some kind of freedom that you're looking for, diversify your wealth, be in a position that's liquid, be in a position that's still earning some interest, be in a position that's safe and protected and hedged. And then when the deals make sense, dive back in. The worst thing to do is just to sit and not action, right? You sit there and you're like, I got this real estate. I know I should be selling it. I've got no depreciation left. I don't have that much cash flow. Or even it's a great deal and it's just a good time to sell because the price is still pretty high. And you don't take the action because you're like, I don't know that I can ever get back in again. And that's why we're here. We're going to make sure you know what's possible and what you have the ability to do. But I think it says in like Ecclesiastes, right? It's like there's a time to sell, there's a time to hold. I think it says something different, right? There's a time to defer the tax to the deferred sales trust. There's a time to 1031 exchange. There's a time, there's a time for all of these different strategies. And the question is it your time to take some action? And that's what we're here to encourage you, to challenge you, to inspire you, hopefully, to take some action. So good question, Clayton. Anybody else have any more questions or thoughts? It takes about 7 seconds for the brain to like relax. You ever heard of this? In 7 seconds, you're like, okay. I wait.
So Brett,
seconds,
who is it not for? If it's not for people that have a lesser amount that we're talking about, who else is it not necessarily for?
You want to spend it all on your fancy clothes, your fancy boat, your fancy car, your primary home, on yourself. Like the government is not going to incentivize us to do 1031 exchanges or deferred sales trusts or even IRAs on personal stuff that we're consuming. That's in their mind, and it makes sense, not necessarily pushing forward the economy, right? Or creating more jobs. It's just your personal consumption. So number one, if you want or need to spend, it's your money, take it, spend it, go, but you're going to pay tax on that. Okay. Number two would be you could have a health concern right now, right? And you could be end of life. And by maintaining ownership, you maintain what's called the stepped up basis, right? And if the property or asset is not prohibiting your life and your freedoms that you want between now and then, we've had people call us and let us know that. And we say, hey, to be honest, because that's the fact pattern right now in your season of life, and it could be imminent here, don't use the DST. Hold on to the asset. Your kids are going to get a stepped up basis. You have no fees, no new trustee, no real, it's just simple. Just hold where you're at. I would say number three would be, besides the deal being too small, honestly, that's kind of it. I don't really see anything else. Pierce, am I missing anything?
I would just say if you're not willing to reinvest the proceeds. So I actually had a client who, had like a $600,000 tax liability, but they did not want to invest in anything. They wanted to put it into super low earning CDs at like 0.1%. And the fees would have just eaten it up, so it wasn't a fit for them because they didn't want to reinvest.
So let me add to that, by the way. So now the question is how long, Pierce, when they say not right now, because this is a 10-year term. And by the way, we did have clients during COVID-19 who did the exact same thing, Pierce. They're like, I don't want to touch real estate. I don't want to touch the stock market. Just sit me in the bank, right? And we sat there for months and months and months.
Sure.
Okay. Now we're invested and now we're doing well, right? And now we practice optimal timing. We're practicing dollar cost averaging. So don't let that be a complete roadblock there. Look at the rest of the story. If they say, yes, for the next 10 years, I only want to sit in money market account making next to zero, it's not going to be a good fit, right?
That was the deal. They had never invested in anything.
Yeah. So there's that fear, right?
Yeah.
Or they're just so stuck by fear, and that could be it. So, okay,
So,
Micah.
Brett, there was one other question Gordon had. He says, spoke with a potential seller of a commercial property that has a 5% cap rate and is reluctant to sell at this point. How should he help that client work through that?
So without knowing the client's specific circumstances and without understanding what their wealth mission is, what their freedom, desires are, it's hard to give like specific advice on what you would say and not say. But I would practice. And by the way, I have a commercial real estate training every Monday. You're welcome to join too. It's called Commercial Real Estate Tactical Training, where we really dive into negotiation. We dive into mirroring and labeling. We dive into how to help clients, go through a process to uncover solutions and uncover desires for themselves and their family and their wealth and their property. That being said, we practice something called mirroring and labeling, right? Well, we ask them, what do they mean by that, right? What do they mean by a 5 cap, right? What do they mean by that? That has a 5 cap rate and is reluctant to sell at this point. How do you respond? And I guess I would say you're reluctant to sell. So you might say, here's a 5 cap offer. And they're like, I'm reluctant to sell. I don't really want to sell at that price. It's not high enough. And you might say, high enough? What do you mean by high enough? And they might say, well, I need to get X price. Well, tell me more about that. What would X price mean for you? And they'd tell you, well, after your commission, I pay you, after this and this, and after I pay my tax, I'm going to be at this. Oh, look for windows of opportunity to really solve their problem. So this is actually, it's encouraging that they're telling you there's challenges for why they're going to sell. And maybe you're already doing this, maybe you're not, but try to get them, don't assume you know what they mean by anything they're saying. And you understand the reasons and motivations behind that. And the way you uncover that is not by asking, hey, what are your reasons and motivations for not selling at a high price? That's going to come across as like, maybe accusatory. Instead, just say like a curious voice, like, hey, I'm curious, what would a 5 cap do for you? Right? What would having a higher or even a 4.5 cap, a higher price do for you and your family and what you're trying to achieve? What are you trying to achieve? When you first thought about selling this in the first place, what were those reasons? Part of that deal we did in Placerville, that $2.5 million with Warren and Catherine, like I had to repeatedly go back to the beginning, because when you're in the heat of it, people get frustrated and they forget their why of why they've enlisted and ready to sell for you in the first place. You have to remind them, hey, remember when we first started this? And this is also important for before you take a listing. If the listing's coming so fast or too easy, guess what? They're probably going to be a little bit fickle too when something shows up. Unless you do the work and allow them to, and really encourage them to do the work of uncovering their true desires and motivations up front. And so what I had with Warren and Catherine, I had that, and then they told me that. We worked through that together. This is a very long relationship too, by the way. It wasn't a speed date relationship. We've known it for 10 years. And we went in detail with what they're trying to do, what they're trying to accomplish. But fast forward, we're in the heat of the thing, and they're like, I don't know if I want to do this deal. I don't think this seller is doing this. I don't want this price. I want this. And I had the deferred sales trust, and we had the projections, right? I had to take them back to the beginning. Like, what's the true motivation? And Warren's true motivation and Catherine was less toilets, trash, liability, more time with the family, more time with our twin daughters that are 10 years old that are wanting to do these, wanting to do stuff with their parents. Like, this is a great age to do it with. We don't want to have to be consumed with this property. So I reminded them back by that. And I said, even so, look what's happening in the future. This market can change quickly. What happens if a year or two from now, the values are lower and you're still doing the same thing you're doing? And as I kind of, I guess, have the carrot, and I don't want to say the stick per se, it's not like a fear thing, which is like, this is some of the stuff we're seeing on the horizon. What is it going to mean for your overall goal? Right. So I guess my last word here is get macro by mirroring and labeling. And by labeling, I mean, he says it sounds like, it seems like, it feels like. It sounds like you have some frustrations with the price. It feels like you're reluctant to sell at a 5 cap because you feel like that's too low. And then you just be quiet. and let them share what the emotion is behind why what's stopping them, if that makes sense. And then once they share that, you almost really kind of repeat that to make sure that you know that they heard you. So that's just a little quick tip. If anyone wants to join on Monday, tactical commercial real estate training, let us know. Every Monday.
Will you put the link in the chat box?
Yeah, go to expmastery.com. expmastery.com. Send us a message there. expmastery.com. I'll put it in the chat box here in a second. And that way you are all welcome to join us. Okay, I think my assistant did too. Cool. Close. We missed the E there, Micah, but it does look kind of cool though. Mastery.
I was keeping you on your toes.
Yeah,
I was
good.
checking to
All
make
right,
sure you
everyone.
actually checked the
We
chat.
are out of time. I want to thank everyone for being here. Rebecca Munson, people want to sell their luxury home in Tahoe or Lake or Truckee. Where can they find you?
They can reach me on my cell, 530-448-9740.
Excellent. Jake Carpenter, people want to get in touch with you, financial advising, anything specifically with financial planning. Where can they find you?
I'm Carpenter Capital. The best way to reach me right now, because we're in a transition with phones and everything, is just call me on my cell, 509-460-8700.
Perfect. Mike, people want to get in touch with you and your amazing husband, Jake Miller, for financial services. Where can they find you?
So our website is strategictaxsolutions.com. There is a linking website there that you can get a hold of us, or you can call us at the 800-773-1848.
Awesome. Pierce York, people want to sell their luxury commercial real estate and or commercial real estate in Newport Beach, Orange County area, and or just check you out on some podcasts as you're rocking and rolling. Where can they find you?
Yeah, you can reach me at my cell, which I put in the chat box, 916-878-0903. You can also go to kingdomluxuryrealty.com, find me there, or on the podcasts. You can find me there.
Awesome, Pierce. Thank you so much. Thank you, everyone, for attending. If you want to get in touch with me, you can go to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. Look for the new book coming out called Building a Capital Gains Tax Exit Plan. That's coming out really like 21 days, people. It's happening. Okay. So look for that. Kevin Hearn from Shark Tank's in the book. DJ Miller's in the book, and it's going to be really, really exciting. That's capitalgainstaxsolutions.com. Thank you, everybody. Talk to you hopefully next week. Bye now.
Yep.